McKell Institute proposed to impose an extreme land wealth levy on 4,630 ultra-wealthy Australians that could raise $3 billion per year. Now, if you think the most powerful people in Australia are worried by this proposal, then you need to pay attention to what I'm about to tell you. According to McKell Institute's proposal, an annual 0.75% tax should be imposed on land the Richie Rich own that is valued between $20 million and $50 million. And those who own lands valued above $50 million should be taxed at 1.25% per year. Experts at the McKell Institute estimate that this could bring in $3 billion per year, which could be used to cut stamp duty for first home buyers, which many critics say is a major reason for slow mobility and low affordability. Under the scheme, principal places of residence would be excluded unless the land value exceeds $20 million. Primary production land would also be exempt unless it is classified as a hobby farm. Qualifying build-to-rent developments would be exempt as well, and land genuinely being developed for new housing could qualify for a time-limited deferral. I mean, are you really serious? Undersupply is the issue, which is why the prices are skyrocketing. And this will not unleash a flood of vacant lands for first home buyers. Even if it does, what about the construction costs? So yes, it is a good move, but a drop in the ocean. How would this policy actually work? If a tax on ultra-wealthy land holdings actually goes ahead, would properties held in trust be included? Short answer, very likely yes, because of aggregation rules. Because in Australia, tax policy usually doesn't stop at the legal owner on paper. It looks at who ultimately controls and benefits from the land. That means moving property into a discretionary trust or family trust typically doesn't remove it from assessment. Why? Because without aggregation rules, avoiding the tax would be simple. You'd just split land across multiple trusts, companies, and personal names, keeping each one below the threshold. And governments know this. So modern tax designs usually include tracing and aggregation provisions. In plain English, they group related entities together when calculating liability. Let's look at a simple example. Imagine Sarah and David have built a portfolio like this. $8 million worth of land held personally, $14 million held in their family trust, $5 million held in a company they control. Individually, none of those structures crosses a $20 million threshold. So under an old style system with no aggregation, no tax payable. But under a tax with aggregation rules, $8 million plus $14 million plus $5 million equals $27 million in combined land value. Now they're $7 million above the threshold. If the tax rate were, say, 0.75%, that's $52,500 per year. Over 10 years, it amounts to $525,000. And that's before factoring in land value growth. This is exactly why aggregation rules matter. Now, supporters argue this improves fairness and helps fund stamp duty cuts. Critics argue it may affect investment decisions and hit asset-rich but cash-sensitive families. But regardless of where you stand, one thing is clear. Trusts are unlikely to be a simple shield if aggregation rules are built properly. And that's the part many investors underestimate.